Welcome to the RSM talkBIG podcast.
What if your superannuation, the nest egg you've been building up for decades, suddenly became subject to a tax on money you haven't earned yet? That was really proposed under Division 296 earlier this year, and it caused a huge stir throughout the financial community. In a previous episode of talkBIG, we explored the initial proposal, a 15% tax on earnings for individuals with super balances over $3 million, including unrealised gains. That episode raised important questions about fairness, liquidity, and the long-term impact on retirement savings. But now the government has backtracked and the rules have changed. Again, is this a fairer system, or have we just moved to a more complicated one? And what does it mean for your retirement strategy? Today, we're going to have a look at the new rules, explore who's affected, and share practical advice on how to prepare before the July 2026 start date. Hello, I'm Andrew Sykes. I've been a business accountant for over 30 years. I talk about business, money, and the economy to help you get ahead. Welcome to talkBIG. Joining me today, I have one of our leading superannuation experts, my partner, Katie Timms, who's our National Director of Superannuation and Self-Managed Fund Services at RSM and also leads our Superannuation Committee. G'day, Katie. How are you?
I'm really good, Andrew. Thanks for having me.
Well, good to catch up again. And we thought it was all settled last time we caught up. And, I think one thing we've learned over years and years of practice, uncertainty around super.
Absolutely. But I will tell you, this is probably the most excited or happy the industry's been about a change in superannuation. Normally, we get a bit frustrated with the constant tinkering. This one, I think most of industry pretty much celebrated when these changes were announced.
Is that because it's simpler than the initial ones? And maybe if you could just briefly remind us, where were we at last time we spoke?
Yeah, absolutely. So look, last time we spoke, we were in a bit of a world of pain and uncertainty. So we had uncertainty in that space as well. What we were facing then was really a system that was designed, as Treasury said, for simplicity, not equity. So what they were trying to do was to make sure that people with really high superannuation balances, so more than $3 million, were not unfairly gaining tax concessions. What they were wanting to introduce was an extra 15% tax on earnings. But the way they designed it is that they thought, well, rather than have to actually determine how much income everyone is generating in their superannuation, we're just going to say how much has your member balance changed in a 12-month period. So as you said, that meant taxing unrealised gains, which was something that was unheard of, in the Australian tax system. So that's where we were. Horrible, proposal for a lot of people, really unfair. People with, fluctuating asset values were going to be really unfairly targeted.
Yeah, and it did seem unnecessarily complex, and it would have made us the only jurisdiction in the world to tax unrealised gains, wouldn't it?
Absolutely, it would have. There was previously a tax proposed in the US to do something similar, which did not get anywhere, which isn't really a surprise. So it would have made us, yeah, you're right, one of the few tax systems in the world that was starting to tax people on money they'd never even made.
Yeah, and that is very problematic because until you actually realise an asset, you're very uncertain as to the gain.
Absolutely. Just because an asset goes up in value doesn't mean that money is always going to be there for you. It may go down again in 2 years' time. But to tax you at the time that just because the value's increased, absolute insanity. It was probably the most frustrating 2 years I've ever spent in the Australian tax system.
Yeah. And I agree with that because we got a stack of queries and a lot of concern from people, even people who weren't going to be affected with the view that, okay, it started there, it's going to trickle down. So we went through that. We went through a very uncertain period of time, and then we get new legislation in October of this year. What are the key changes to Division 296 in that legislation?
Yes. So in this instance, it seems like lobbying actually paid off. So we saw a few key changes. Number one, they did agree to index that cap. So previously it was sort of deemed that it would be, well, it's $3 million regardless of the, impact of inflation and things. That's the cap and we're going to stick to that. They have changed that. So the indexation will automatically occur, to CPI in increments of $150,000. The big change we got, though, obviously the big one we were fighting for, was they've moved away from this concept of taxing unrealised gains. So they've said, look, instead of taxing you on market movements, we're going to let your super funds report to the tax office what income your member account has actually generated, and then at ATO will do the tax calculations and apply it from there. So it means instead of taxing, these fluctuations in asset values, the super funds will say this is what your member account earned in actual income, and they will tax you on that. Now, the other thing they did bring in, though, was a second cap. So we've still got the first cap. So for people with a balance over $3 million, they will pay an additional 15% tax on the proportion that exceeds $3 million. So it's a little bit of a complicated calculation. But for people that have a balance of over $10 million in superannuation, they will pay an extra 10% tax on top of the 15 that they'll already be paying. So that's sort of their way of trying to make sure that they're capturing as much revenue as they had initially hoped they would.
Okay, so just to make sure we're clear on that, so we're now going to have a tiered system within superannuation, and we have a tiered system in personal tax. So it's a very similar concept. So first tier up to 3 million will pay how much?
So first tier up to $3 million will not pay any Division 296 tax. Those people will just pay normal tax in superannuation however they normally would. Once you get over $3 million, so between $3 million and $10 million, you will pay an extra 15% tax on earnings on the proportion that's over $3 million. And then at $10 million, you'll pay another 10% on top. So 25% on the earnings.
Okay, so if I'm running my self-managed super fund, I've got to say, about 1.5 million, I'm in pension phase, no implications at all.
No issues for you. You will just tick along as you were before.
Even in accumulation phase, I'm going to be paying 15% tax up to the 3 million. Once I get over that 3 million, that proportion over the 3 million will attract another 15%. So any balances over that, it'll be proportional over the 3 million will be 30 cents in the dollar. And then there's a 10 million as well.
Yeah, that's right. And that proportion's a really important part of the, determining how this tax is going to impact you. Because if you're only just over $3 million, let's say that, you're 3.1 million, we are only $100,000 over 3 million. So your proportion's going to be really, really small. It's as you get to the higher balances that this tax starts to become a little bit more, impactful.
Yeah, and look, that is a really, really important point that I think we should emphasize, because that's probably the biggest query, or most queries I get is, my whole slip is going to be taxed at 30%. It's not. You'll pay 15% tax up to 3 million. And then if you earn, as you say, that extra 100,000, you might earn 6 or 7% on that, $6,000, $7,000, and you'll pay 30% tax on that. So it's going to be an impact, but not a
nowhere
huge
near as much.
Yeah.
That's right.
So who's most likely to be impacted by this, Katie?
Look, well, it's actually really interesting you say that. So there's probably a few people impacted. The tax system now that we're going to have with superannuation up until $10 million is still probably the most concessionally taxed environment to hold your assets. Because of the way the pension system works, with superannuation balances. So, when you're in pension phase, you pay 0% tax. That's a lovely tax place to be. So that might mean that you're only paying Division 296 tax if your balance is over, $3 million. The impact is going to come for people the higher their balances get. They're the ones that are going to start to see, the impact of this tax coming in. The biggest impact on this is actually going to be, and we don't want to say poor me, but on the administrators and on the APRA and retail funds, because there's a reason why the government didn't go with this system in the first place. It's because the APRA systems aren't designed to be able to report in this manner. And so we're really interested to see how that's going to play out long term, because administratively, we don't really know how they're actually going to manage this, and we're 6 months away from it kicking off.
Yeah, and historically, would it be correct to say that when we have seen complex changes, increased administration costs are passed on to the members just to meet administration needs?
Absolutely. So, I know that the software providers for SMSF land are already, in the background going, okay, well, we need to redevelop this. That's going to be increased software costs, that are going to be passed on. The ATO is actually going to require the super fund to report to them the information they need. Now, this is a different calculation than it is to normal tax returns. So we're not just going to be able to pull the data straight out of there. So there's going to be another, tax reporting impost for the accountants, for superannuation funds. And that is unfortunately going to come at an extra cost, for the individuals.
Yeah, it has to be paid by the members, which is unfortunate. So if we look at that capital gain, so we've moved away from the concept of unrealised capital gains. How are capital gains now going to be taxed?
This is probably the really big uncertainty we've got, because we are, we're all desperately, it's a bit sad, but all of us in the super community are, checking the Treasury reports every day. We're waiting for that final legislation to come out. So Jim Chalmers has made a couple of announcements to suggest that there would be some form of capital gains tax relief applied if you were going to be impacted by this tax. What we're missing is a little bit of the detail. So we don't really know, does that mean that we're just going to reset balances at 30 June 2026? So, if you sell an asset after that date, well, your new cost base is going to be the balance on 30 June 26. Are they only going to apply that relief for Division 296 tax purposes? And so what I mean there is that, you've got a cost base that you've purchased the asset for in the superannuation fund. They might say, well, we don't want you to have to pay this extra new tax on, on assets that you might have owned for 10 years, but you still have to pay according to the old CGT regime for income tax purposes. So we might then now be running two separate cost bases, for different tax systems. So we are really desperately waiting to see what that's going to look like.
Yeah, it looks like we're doing another podcast in March or April as more rules come out. So CGT, we're pretty certain and comfortable we're going to enter into that new tiered tax regime, 15% up to 3 million, 30% on earnings on balances over 3 million, and then another 10%. So 40% on earnings over the 10 million mark. CGT will put it down as we're starting to get some guidance, but we need to circle back and make sure it's right early next year, or when the government makes it clear.
So we were told they were intending, because they're really keen to get this through, so we were told that legislation would be released before Christmas. So we don't have a lot of days left for that, for that to come out. And they've really left this with a really short consultation period. So from what we've heard, they want this passed by March, because it does come into effect by the 1st of July 2026. So somewhere between now and March, there's going to be a lot of work being done. There's going to be people who are thinking about what they need to do to get themselves ready for this, and any decisions they might need to make in advance.
Yeah, and to be fair, it's not a lot of time between March and 30 June.
It is not a lot of time at all. And what's really interesting is that when they first announced Division 296 tax, February 2023, I mean, that's how long this has been discussed. They were really clear when they released that they needed a lot of time to implement, because they wanted to give people at least 2 years to get their affairs in order. Now, obviously, we're going to be looking at a 3-month deadline to get our affairs in order, which is very, very different from what we have. But look, I want to be really clear. These are really positive changes that have come out. We are not unhappy with the announcements. We just are desperate to see the detail so people can actually make plans.
So on balance, you would say we have a simpler regime. There's just a little bit of uncertainty left. I hope you don't have any leave booked for the first 6 months of next year. It's going to be brutal.
It is going to be a tough run. I mean, look, at least, for a lot of people, at least when we got these announcements, it was like, okay, we actually understand now where we're going. So we can make concrete decisions. We've sort of been spending the last 9 months waiting to see what the government was going to do. They announced after the election they were intending to push through with this. It was going to be a big revenue raiser for them. And then it didn't get through Parliament. And then it just kind of got dropped and sat there, and we were all sitting in this uncertain land. So it's going to be a busy time. There's going to have to be decisions made in a short period of time, but at least we are moving into a regime that is better.
Yeah, okay. So for most people, this is not going to have a massive impact. But always when we have a big group like this, there's going to be some outliers there. Are there any groups that will be, we think might be unexpectedly affected by this or harshly impacted by it?
Look, some of that is going to depend on how they frame this capital gains tax relief. So that's going to be one. If they do it in a fair manner, that's going to erase a lot of the complication and complexity. For those, however, moving forwards who are going to be impacted, so one area where people need to kind of understand is that maybe they're going to be under $3 million now, but if there's a husband and wife and there's an intention for the benefits to pass to the other, two people with $2 million all of a sudden becomes four, then they're going to drop into the regime. So really understanding when that timing is going to hit people. For those people that love a speculative investment, so people that maybe are not going to have the CGT relief this year, but in a few years' time have got those investments that have massive gains, may find themselves impacted by this in a higher tax environment that they were initially intending.
Yeah, so is that deal. So what are the practical challenges for some of our self-managed super fund clients, in particular those with illiquid investments like property and like farms, for example? Do you see more of an impact there?
Look, farmers have been the hottest topic, of conversation from the start, from when this tax first came in, because we've seen really big value fluctuations over a long period of time. And farms aren't assets that we necessarily just sell. These are family investments. These are intergenerational. So just because something maybe makes a capital gain or a profit, on a transfer to the next generation, doesn't necessarily mean that we've got lots of cash floating around to be paying this tax. Look, I will say these changes are absolutely of benefit to those farmers in that. But I think what we're starting to see is really the question around a lot better succession planning for farms that are sitting inside of super. What's the point where we really want to look to start to transfer that? It's been positive in that it's generated a lot of conversation around what's the plan? How long do we want to keep it in here, knowing we've got this new tax, knowing, we've still got death benefits tax that's floating around. So from that perspective, that's been a positive.
Yeah, and it's a really difficult one because a farm's an unusual capital gain because you need the farm to earn the income. You can't keep on selling parts of the farm to pay tax. It's a very, very difficult one, particularly for intergenerational. Now, are you starting to formulate any strategies, or what should people be doing now to plan ahead of 1 July 26?
Look, I've told everyone we're not doing anything till at least the new year because I really want to get a good look at this legislation and this capital gains tax relief, because to me, that is the key to a lot of the decisions that'll be being made. So there will be probably a lot of conversation for people around starting to look at how they're going to value their assets on 30 June 2026. That's going to become a really key date for CGT relief to determine, what is your opening balance when this tax kicks in, all that sort of thing. So I'm saying to people, please, I know I've been saying this for 2 years. Please, let's be patient. We just need to wait a little bit longer. Once we've got the detail onto that CGT relief, we're going to have a really good idea for, okay, what do we need to be doing in the next financial year?
Yeah, thanks, Katie. So this is a major policy shift still, even though it's simpler, it's still a major policy shift. Is this signalling a different direction with super over the next few years? Are we going to get more changes? We did have that period where super changed every year, and then it settled down for quite a while. Do you think there's a lot more coming down the pipeline to us?
I think there will be more coming down the pipeline. I have always said, and I stand by this, the changes that were made in the 2016-17 year, which, brought in the pension caps and, changed a lot of the rules, were some of the biggest changes we'd seen, but were probably some of the smartest because they were putting in place things that were going to make things smoother for the long term. It was really a long-term strategy. What we've seen now is a reaction to, well, that's taking a bit longer than, to generate the revenue than we'd hoped. Having said that as well, so, based on the reactive nature of this legislation, I think we're going to see more changes. The Greens, if you've been following, I'm sure everyone's following the super news as closely as I do, but, the Greens have started making comments again about how borrowing arrangements inside of super should not be there. It's contributing to the housing crisis, even though there's not a lot of evidence to really suggest that. There's not a lot of love for those sort of things. I would be very surprised if they're still with us in 5 years' time. I think there's going to be pressure on those. I think we're going to see, though, more pressure on a lot of the taxing concessions that are in superannuation. It is still a great environment. It is still the most concessionally taxed. And unfortunately, we see tinkering for the short term instead of, really positive long-term strategy.
Yeah, and look, I couldn't agree more with anything that you said there. I still think super is a great environment, though. Really make sure you get your own personalised advice before you do anything with your super. I do think these changes mean that self-managed super funds aren't as passive as they used to be. I think you're going to be very active in your management and your structuring with them. If we summarize what you said, is that we've got some certainty around the income tax and the new tiered structure, and we're not that unhappy with it. And I think a lot of people would be surprised how small the impact is. But stay in touch with your advisor around the capital gains tax, because we need that finalised. Katie, that's all we've got time for. Really good update. Absolutely terrific. Thank you for that and sharing your insights. To all our listeners, invite you to download and subscribe to our podcast wherever you get your podcasts from. Thank you for joining us on Talk Big, and we will talk to you next time.